IT's leaked. U.S. Mint quietly reprices silver to 100 times 23, so they know it's finished. While traders watched silver hover around $90 on their screens this week, the United States Mint made a move that changes everything. They updated their internal pricing system. The number they published? $173. Not a typo, not a mistake, a deliberate repricing. The same government that prints the currency just admitted the currency is broken, but here's what they're not telling you. On the exact same day, 4.2 million ounces vanished from the vaults, gone in 24 hours. The paper price says 90, the government says 173, and the metal is disappearing. Someone knows something we don't. And what happened next will reshape the entire precious metals market. Welcome to John Analyst, where we decode the financial signals the mainstream ignores. If you've been in business long enough, you know that the most important information rarely makes headlines. You've learned to read between the lines, to spot the warnings before the crowd panics. That's exactly what we do here. So if you appreciate analysis that treats you like the experienced decision maker you are, not like someone who needs hype or hand-holding, go ahead and subscribe. Hit that button. Because what we're about to walk through in the next few minutes requires your full attention. And before we dive in, drop a comment below. Tell us where you're watching from. Are you in New York, London, Singapore, Mumbai? Let us know your city, your country. We want to understand who's paying attention to this, because this signal is global. All right, let's break down exactly what just happened and what it means for your assets. On Friday afternoon, January 16th, something unprecedented occurred in the American monetary system. While most investors were analyzing charts and debating whether silver's rally to $90 represented a top or beginning, the United States Mint made a decision that exposed a truth the financial establishment has spent decades concealing. They repriced silver not by a few dollars, not by 10%, but by 92%. The official internal pricing for the Proof American Silver Eagle was updated to $173 per coin. The uncirculated bullion version? $169. Let that register for a moment. The spot price trading on the Comex exchange closed the week at $90.14. The United States Mint, the sovereign entity responsible for minting the nation's coinage, or the institution that literally creates currency, set their price at $173. This is not a premium for collectability. This is not a markup for craftsmanship. This is an admission. When the entity that prints money nearly doubles the price of a commodity while simultaneously refusing to sell that commodity, they are telling the market something critical. They are saying the paper price is fiction. Now, the skeptics will argue that the mint has suspended sales, that this pricing update is meaningless because no transactions are occurring. But this argument misses the strategic significance entirely. Why would a government agency, which is currently closed to public sales due to what they claim is a pricing backlog, go into their internal systems and update their pricing to reflect a 92% increase? They are doing it because they are front-running reality. The Mint understands that when they eventually reopen their sales window, whether that happens next week or next month, they cannot offer silver at $90. If they did, they would be looted. Every dealer, every institutional buyer, every informed investor in America would immediately place orders to extract metal at a 50% discount to its actual replacement cost. The government would effectively be giving away a strategic asset. By setting the internal price at $173, the Mint is signaling where they believe the true clearing price exists. They are establishing the benchmark for future transactions. They are admitting that the derivative market, the paper contracts traded in New York, bears no relationship to the cost of acquiring physical metal. This creates what analysts are now calling a two-tier market structure. In Tier 1, Wall Street traders exchange digital contracts back and forth, pretending that silver exists at $90 per ounce. These are derivatives, promises to deliver, obligations settled in cash more often than metal. In Tier 2, the physical world operates under entirely different economics. The mint, the refiners, the industrial buyers who actually need to touch the metal, they know that $90 is not a real price. It is a quote on a screen, not a transaction in the vault. When the spread between the paper price and the physical price reaches $83, the exchange is no longer discovering value. It is discovering insolvency. Consider the psychology this creates for anyone holding physical silver. If an investor sees the United States government pricing silver at $173, are they going to sell their holdings for $90? Of course not. They are going to hold. They are going to wait. They are going to realize that their asset is worth substantially more than what the banking system is willing to pay for it. This destroys the liquidity that short sellers desperately need. The major banks, the institutions that have sold billions of ounces worth of paper silver contracts, need physical holders to sell. They need supply to enter the market so they can cover their positions. But the U.S. Mint just sent a signal to every silver owner in America: hold your metal. Do not accept the paper price. The government itself is telling you that the real value is double what the screen shows. This is perhaps the most significant inadvertent diamond hands narrative ever created by a sovereign institution. And the timing of this repricing reveals even more. This update occurred on Friday afternoon, immediately after a massive attempt to suppress the paper price failed. On Thursday, the banking establishment tried to drive silver down to $86. They deployed their usual tactics: algorithmic selling, derivative pressure, media silence. The attack failed. The market absorbed the selling and closed the week above $90. The first weekly closed above this psychological barrier in history. And the very next day, the Mint raised their internal price to $173. This is not coincidence. This is war. It is a conflict between the deflationary forces of the paper market, which need lower prices to protect the dollar's purchasing power, and the inflationary reality of the physical world, which demands higher prices to justify production and replacement. The U.S. Mint has chosen a side. By pricing at $173, they have aligned themselves with physical reality. They are admitting that the purchasing power of the dollar has collapsed to such a degree that a single 1-ounce coin now costs nearly 200 units of currency. This is what a currency crisis looks like in real time. It does not announce itself with a dramatic crash. It reveals itself through a series of repricings, where the cost of real assets suddenly jumps overnight to reflect the debasement of the money. The screen says $90. The Mint says $173. Which price reflects reality? The price where someone can buy a digital contract that might be settled in cash? Or the price where someone can acquire a physical coin they can hold in their hand? The answer should be obvious to anyone paying attention. But if the Mint's repricing was the signal, what happened in the vaults on Friday was the action. While the United States Mint was quietly updating numbers on a government website, a very different operation was unfolding in the shadows of the financial system. Something that would only become visible when the weekend warehouse reports were published. Something that would reveal the true panic happening behind closed doors. The CME Group releases daily vault reports. These documents typically attract little attention. They are mundane, bureaucratic, filled with minor adjustments as metal moves in and out of authorized depositories. A few thousand ounces here, a few thousand ounces there. Normal business. But the report published for Friday, January 16th, was anything but normal. It screamed emergency. In a single 24-hour period, 4.2 million ounces of physical silver were withdrawn from the Comex vault system. 4.2 million ounces. To put this into perspective, that represents roughly 130 metric tons of silver. This is not a jewelry manufacturer ordering supplies. This is not a retail investor buying coins for their portfolio. This is industrial scale extraction. This requires armored trucks, cargo logistics, coordinated security. This is the kind of movement that happens when institutions know something the public does not. But the scale is only part of the story. The distribution of these withdrawals reveals something even more significant. 1.4 million ounces were pulled from the Asahi depository. 1.2 million ounces were extracted from CNT. Another 1.2 million ounces disappeared from JP Morgan's vault. And nearly 800,000 ounces were removed from Manfred Tordella and Brooks. This was not isolated activity at a single location. This was a coordinated raid across every major custodian in the Comex network. A simultaneous extraction happening at multiple facilities, as if orchestrated by a single directive. And here is where the timeline becomes impossibly suspicious. This massive withdrawal occurred on the exact same day that the paper price of silver was crashed to $86. On Thursday, the price dropped $6 in a matter of hours. Aggressive selling, technical breakdowns, stop losses triggered, the typical pattern of a coordinated suppression event. And then, on Friday, 4 million ounces left the building. Some observers might call this coincidence. Market analysts who understand how these systems actually function call it something else. They call it a heist. The mathematics are straightforward. If an institution is withdrawing 4 million ounces of physical silver, a $6 drop in price represents a $24 million savings. Crash the price, then execute the withdrawal at the suppressed level. It is cost-effective looting. But the most alarming number in the Friday report is not the total withdrawal. It is what happened to registered silver. The Comex vault system categorizes metal into two classifications. Eligible silver is metal stored in the vault, but not available for delivery against futures contracts. It is inventory with a not for sale sign. Registered silver is different. This is metal that is actively available for delivery. It is the buffer, the safety margin, the physical backing that gives the paper market credibility. On Friday, registered silver collapsed by over 2.5 million ounces. It fell to just 120 million ounces. This is the liquidity cushion that prevents defaults, and it is evaporating. When registered inventory drops this dramatically, it means the owners of that metal are removing it from the market. They are taking down the for sale sign. They are moving metal from public availability into private hands. Why would they do this? Why would vault holders remove inventory precisely when prices are hitting multi-decade highs? Standard economics suggests the opposite behavior. High prices should bring supply to market, not remove it. Unless the holders know something about what is coming next. There are whispers circulating through institutional circles. References to the Trump administration's Section 232 review. Discussions about potential declarations of silver as a critical mineral. Talk of possible price floors. Export restrictions. Strategic reserve requirements. If an institution believes the government is about to reclassify silver as a strategic asset, they do not want their metal sitting in a public vault in New York. They want it out. They want it in private custody. Or better yet, they want it offshore. Intelligence suggests that a significant portion of this 4 million ounce withdrawal is being redirected. Some is heading to London, where the LBMA vaults are reportedly running dangerously low on available float. Some is being shipped to Shanghai, where the premium over Western prices continues to widen. The banks are playing a desperate game. They are draining the Comex to plug holes in London. They are robbing the New York vault to satisfy Shanghai demand. They are moving metal from one crisis point to another, hoping to delay the inevitable reckoning. But they cannot move what does not exist, and the vault data suggests they are running out of inventory to shuffle. If the current rate of depletion continues, if 4 million ounces per day becomes the new pattern, the registered category will be completely drained in 30 trading days. 30 days. That timeline lands directly on the March delivery month. March is historically one of the largest delivery months for silver futures. The open interest data shows that traders are positioning for physical delivery in record numbers. They are not rolling contracts forward. They are standing for delivery. They want metal, not promises. But if the vaults are drained in January and February to satisfy Asian arbitrage and European shortages, what happens when March delivery demands arrive? There will be nothing left to deliver. This is the force majeure scenario that precious metals analysts have warned about for years. The moment when the exchange cannot fulfill its contractual obligations. The moment when they inform contract holders that physical settlement is impossible and offer cash compensation instead. But industrial users do not want cash. They want silver. They need it for solar panels, for electronics, for medical applications. Cash does not manufacture products. So the Friday night vault raid was not simply a large transaction. It was a signal. The insiders are exiting. The smart money is taking physical possession, while physical possession is still possible. For anyone watching these markets, this is the clearest warning available. When the banks themselves are draining the vaults, when the government is suspending sales, when the registered inventory is collapsing, the question becomes unavoidable. If the largest players in the world are grabbing metal and running for the exits, why is the retail public still holding paper contracts? But that is exactly what they are doing. And the data on retail behavior reveals something equally extraordinary. While the sophisticated institutional players were quietly extracting physical metal from the vault system, a completely different story was unfolding on the retail side of the market. A story that reveals both the power of public sentiment and the tragedy of misplaced trust. For decades, the silver market was a niche corner of finance. It attracted a specific type of investor: contrarians, sound money advocates, people who distrusted central banks and fiat currency. The crowd was small, passionate, but ultimately marginalized by mainstream finance. But something fundamental shifted over the past 6 months. The psychology of the average investor began to change. The Comex letter, one of the most respected institutional analysis firms, just published data that confirms what many suspected. Retail investors have been net buyers of the largest silver ETF, SLV, for 169 consecutive days. 169 days. That is nearly 6 months of uninterrupted, relentless accumulation. It represents the longest sustained buying streak in the recorded history of the fund. In the last 30 days alone, silver ETFs have absorbed over $920 million in new capital. The buying activity is running at more than double the 3-month average. To understand the magnitude of this shift, consider the comparison to 2021. In early 2021, the Reddit-driven silver squeeze made headlines. It was loud, viral, explosive. Retail investors coordinated to buy physical silver and SLV shares, attempting to break the bank's alleged price suppression. The movement generated enormous attention, but it was brief. It lasted weeks, not months. The public bought the spike, then sold when prices corrected. This time is different. This is not a flash mob organized on social media. This is not a meme-driven speculation frenzy. This is a sustained migration of capital. Money is flowing out of traditional equity markets, out of bonds, out of savings accounts, and into hard assets. The public is seeking safety. They are responding to inflation, to currency debasement, to geopolitical instability. They are making a rational decision based on deteriorating confidence in paper wealth. But here is the tragedy embedded in this story. The overwhelming majority of this capital, billions of dollars, is flowing into the wrong vehicle. Retail investors believe they are buying silver. They see the ticker symbol, SLV, and assume they are acquiring exposure to physical metal. They think that by purchasing shares, they are removing supply from the market, tightening the squeeze, forcing the price higher. They are mistaken. When an investor buys a share of SLV, they are not purchasing a bar of silver. They are purchasing a trust unit. That unit represents a claim, a contractual promise, that somewhere in a vault, there is silver allocated to the fund. But the investor does not own that silver. They own a derivative of that silver. And the entity that controls the actual metal, the custodian of the vault, is JP Morgan. The same JP Morgan that the Friday vault data showed withdrawing 1.2 million ounces, the same JP Morgan that market analysts have identified as one of the largest short sellers in the silver derivatives market. This creates a conflict of interest so severe it defies rational market structure. The custodian holding the physical asset is simultaneously betting against that asset in the derivatives market. They control the supply, and they profit from suppressing the price. For the retail investor, this structure is a trap. But the situation extends far beyond a single ETF. Recent reports indicate that major global banks, specifically Bank of America and Citigroup, are carrying massive derivatives exposure in precious metals. Some analysts estimate their combined gross short position could represent as much as 4.4 billion ounces of silver. 4.4 billion ounces. Global silver mining production runs approximately 800 million ounces per year. These banks have sold paper contracts representing more than 5 years of total worldwide production. They have sold silver that has not been mined, silver that has not been discovered, silver that may not even exist in economically recoverable deposits. This is the textbook definition of a naked short position. And the banks are now trapped between two crushing forces. On one side, the retail public is pouring billions into the market, 169 consecutive days of buying. Every dip gets purchased. Every price drop triggers more accumulation. The public is not selling, they are buying. On the other side, the physical vaults are being drained. 4 million ounces disappeared on Friday alone. The collateral backing the paper contracts is leaving the system. The banks are caught in a tightening vice. If silver rises to $100 per ounce, the mark-to-market losses on a 4 billion ounce short position become catastrophic. It would erase the equity capital of these institutions. It would require government intervention, a bailout larger than what was needed in 2008. This explains the violence of recent price action. This explains why the banks engineered a $6 crash on Thursday. They are not fighting for profit. They are fighting for survival. But the retail swarm is proving relentless. The 169-day buying streak demonstrates that the public is not capitulating. They are not being shaken out by volatility. Every time the banks smash the price, the ETF inflows accelerate. The lower the price goes, the more attractive it becomes to inflation-fearing investors. The banks are attempting to scare the public away. Instead, they are inviting them in at better entry points. This is the unstoppable force meeting the immovable object. The unstoppable force is the public's fear of currency collapse. The immovable object is the insolvent banking cartel. Something must break. And based on the vault depletion documented in Part 2, the thing that is breaking is the physical inventory. The ETF structure functions as a buffer. It absorbs retail demand and keeps it away from the physical market, temporarily. The authorized participants who create and redeem ETF shares can use accounting mechanisms, leasing arrangements, and derivative hedging to satisfy the fund's rules without actually moving metal. But this game has limits. Eventually, the disparity becomes too extreme. If SLV claims to hold 500 million ounces in its vault, but that metal has actually been shipped to Shanghai to satisfy arbitrage demand, the fund implodes. The moment of reckoning arrives when the paper claims exceed the physical atoms by a ratio that triggers systemic failure. And that moment is approaching. The retail public has the correct instinct: buy silver, protect against inflation, exit the dying currency system. But they have chosen the wrong execution. They are buying the map instead of the territory. They are purchasing a receipt for a car that has already been stolen from the parking lot. When the squeeze finally breaks the banks, when the defaults begin, the ETFs will almost certainly be settled in cash. The fund will send investors a check denominated in the very currency they were trying to escape. They will receive dollars, but they wanted silver. The Friday night vault heist was the smart money taking the metal before the ETF holders realize it is gone. The 169-day buying streak proves that sentiment has shifted. The public is awake. They understand the dollar is being destroyed. They are voting with their wallets, but they are casting their votes in a rigged election, and the results of that election are about to be announced. Because when the markets open on Monday morning, all of this suppressed information is going to collide with price discovery. The evidence has been presented. The sovereign signal from the United States Mint, pricing silver at $173, while the market trades at $90. The vault exodus, 4.2 million ounces vanishing in a single day as registered inventory collapses toward zero. The retail paper trap, 169 consecutive days of buying into ETFs while the physical metal disappears from the system. These are not theories. These are documented facts. And together, they form a picture of the largest pricing anomaly in modern financial history. Today is Saturday, January 17th, 2026. The markets are closed, but the information is spreading across trading desks in Singapore, in London, in New York. Analysts are reviewing the same data. They are performing the same calculations, and they are arriving at the same inescapable conclusion. The paper price of silver is a fiction that cannot survive contact with physical reality. Look at the numbers one final time. The Comex spot price closed Friday at $90.14. The Shanghai Premium closed the week at $12 over New York, effectively pricing silver at $102 in the Chinese market. The United States Mint has internally priced silver at $173. The gap between New York and the sovereign issuer is $83. That is not a normal market spread. That is not a temporary dislocation caused by shipping costs or processing delays. That is a chasm. That is the Grand Canyon of financial risk. When an investor can theoretically buy silver for $90, and the government that creates the currency says that same silver is worth $173, when arbitrage opportunity exists that defies economic logic. It suggests buying dollars for 50 cents. It suggests acquiring an asset at a 92% discount to its sovereign valuation. Under normal circumstances, this gap would close within hours. Arbitrageurs would flood the market, buying at 90, selling at 173, capturing the spread until equilibrium was restored. But these are not normal circumstances. The gap exists because the metal is not available. The vaults are empty. The mint is not selling. The registered inventory is collapsing. So the price discovery mechanism has broken. There are only two possible scenarios for how this resolves. Scenario 1, the U.S. Mint is catastrophically wrong. The shortage is illusory. The vault withdrawals were temporary. The 4 million ounces that disappeared on Friday will return next week. Industrial demand will collapse. Retail investors will panic, sell their ETF shares. The banks will cover their short positions at a profit, and the price will crash back to $90 or lower. For this scenario to occur, every data point analyzed in this investigation would need to be reversed. The inelastic industrial demand for silver and solar panels, electronics, and green technology would need to disappear. The mines that are already depleted and facing declining ore grades would need to suddenly discover vast new deposits. The retail buying streak that has lasted 169 days would need to turn into sustained selling. The sovereign entity that just repriced its product at $173 would need to admit it made a catastrophic error. Given the totality of evidence, this scenario is not just unlikely, it is impossible. The metal is gone. It is not coming back at $90. Scenario 2. The paper price gaps up to meet physical reality. The Comex futures market, the derivative contracts, the digital promises, all of these paper mechanisms are lagging indicators. They are the last things to move. The physical price leads. It always has. The Shanghai Premium confirms the direction. The U.S. Mint pricing confirms the magnitude. And eventually, the paper price capitulates. It has no choice. When the March delivery month arrives and the vaults cannot fulfill their obligations, when industrial buyers are willing to pay $120 for metal they cannot source, when the authorized participants can no longer create ETF shares because there is no physical metal to allocate, the paper price will gap violently, without warning. And it will continue gapping until it reaches a level where physical supply returns to the market. Based on the Mint's pricing, that level is somewhere north of $170, which brings us to Monday morning. Right now, this weekend, the news is spreading through professional networks. Fund managers are reviewing the vault data. Sovereign wealth funds are recalculating their precious metals allocations. Family offices are instructing their advisors to acquire physical exposure. When Asian markets open Sunday night, and when New York opens Monday morning, there will be a rush, not from retail investors. They have already been buying for 169 days. The rush will come from institutional capital that has been sitting on the sidelines, capital that was waiting for confirmation. The U.S. Mint just provided that confirmation. When a government entity prices silver at $173, then $95 is cheap, $100 is cheap, $120 is cheap. This creates a front-running dynamic that overwhelms the bank's algorithmic suppression systems. The algorithms are designed to manage normal market flows. They are not designed to manage a sovereign repricing event. So what is the verdict? The verdict is that the great repricing has already begun. The era of double-digit silver is over in the physical world, even if the screen has not yet acknowledged it. The verdict is that the banks have lost control of the physical inventory, which means they have lost control of the price. They can print contracts, they can manipulate charts, they can engineer flash crashes, but they cannot print metal. And the verdict is that the world is witnessing a historic wealth transfer. A transfer from those who trust screens to those who trust scales. A transfer from paper claims to physical atoms. A transfer from digital promises to tangible assets. So what should a rational economic actor do with this information? Rule 1. Do not sell physical metal. When silver crosses $100 next week, the temptation to take profits will be overwhelming. The mind will calculate gains, imagine what those gains could buy, and urge liquidation. Resist this impulse. Remember the U.S. mint price. If an investor sells at $100, they are selling at a $73 discount to the government's own valuation. They are accepting pennies on the dollar. Do not trade a scarce strategic asset for a currency that is being systematically debased. Hold until the paper price matches the physical street price. Rule 2. Ignore the volatility. The banks are wounded, but they are not dead. They will attempt more price smashes. They may drive silver down to $88 on Monday to trigger stop losses and create panic. If this happens, understand it for what it is. It is a paper game. It is chart manipulation. The real game is being played in the vaults, and the vaults are empty. Short-term price movements on a screen are irrelevant when the underlying physical market is in structural deficit. Rule 3. Monitor the spread. The most important metric right now is not the price of silver. It is the difference between the spot price and the physical price. As long as the U.S. Mint is priced at $173 and the Comex is below that level, the bull market is structurally intact. The squeeze is active. The moment that spread collapses, the moment the paper price rises to meet the physical price, that is when the resolution has occurred. Until then, the dislocation persists and the opportunity remains. What the world is witnessing is the slow-motion collapse of a 50-year scheme, a scheme to suppress the price of real money while printing unlimited quantities of fake money. It is messy, it is volatile, it will be denied by officials and dismissed by mainstream commentators, but the mathematics are undeniable. The United States government just revealed what they believe silver is worth, $173. They would not publish this number if they did not have to. They would not suspend sales if they had inventory to sell. They would not allow the vaults to be drained if they had confidence in the system. The banks are short. The mint is closed. The vaults are empty. And the price is $90. This is not a prediction. This is not speculation. This is recognition of disclosed reality. The sovereign has tipped its hand. The only question now is who will act on this information before the window closes. Because when the paper price finally gaps up to meet physical reality, the opportunity to acquire metal at these levels will be gone forever. The great repricing is not coming. It is already here. The screen just has not updated yet.